Vital Farms, NASDAQ VITL, was once the perfect golden egg. By leveraging pasture-raised practices, animal welfare, and a transparent supply chain, the company achieved an annualized revenue growth rate, CAGR, of approximately 25 to 30% over the past 3 years, far outpacing the industry average through brand premiums and channel expansion. Recently, however, this egg appears to be in a freefall. Judging by the FY 2025 results and 2026 guidance, VITL's core moat seems to be eroding. While 2025 revenue reached $759 million, up 25.3% YOY, management's 2026 guidance is set at only $900 million to $920 million, signaling a gear shift from 30% plus growth down to 18 to 21%. To the bears, the most lethal data point is likely the inversion of adjusted EBITDA margins. This metric stood at 15.0% in 2025, but 2026 guidance suggests a contraction to roughly 11.5% to 12.2%. This isn't just a numerical dip, it reflects deeper anxieties. To maintain a 14.2 million household penetration amid inflation, the company has been forced to ramp up marketing and promotional spending. This is essentially sacrificing gross margin to hedge against the rise of private labels, supermarket house brands, and reflects broader concerns over consumer downtrading, a familiar scent of recession fears. Even more alarming to shorts is the hemorrhaging of cash flow. The company plans $140 million to $150 million in capital expenditures, CapEx, for 2026 to build out the Phase 2 facility of Vital Crossroads in Indiana. With free cash flow, FCF, expected to turn negative, this asset-heavy gamble faces a major risk. If demand growth fails to meet expectations, tens of millions in annual depreciation costs will directly swallow the company's future net profits. However, if one extends the investment horizon to a 3 to 5 year cycle, this fall takes on a completely different physical meaning. The current drop is not a collapse, but a conversion of momentum in preparation for a rebound. This egg won't break. In fact, it is likely to become even more resilient. The egg won't crack. The balance sheet remains rock solid. As of the latest report, the company holds approximately $113 million in cash with zero long-term debt, an exceptional financial position that provides a sturdy moat for its $140 million to $150 million capacity doubling plan in 2026. First, in an industry hyper-dependent on freshness and logistical turnover, whoever owns the most efficient physical processing nodes owns the strongest pricing power and waste control. That massive capex is the physical foundation for VITL's $2 billion revenue goal by 2030. The barrier to entry in the premium egg industry isn't marketing. It's a highly complex supply chain that is notoriously difficult to scale. VITL currently partners with over 600 family farms. Once the new plant is operational, daily processing capacity will increase by over 80%. Once these economies of scale are unleashed in 2027, the fixed cost per egg will drop significantly, driving EBITDA margins back toward the long-term target of 15 to 17%. Second, valuation misalignment has created highly attractive odds. VITL's price-to-sales, P/S ratio, has retreated to approximately 0.78 times. In contrast, traditional mature food giants usually trade at 1.5 times to 2.0 times PS, even though VITL maintains a growth rate double the industry average. The market is currently pricing it as a commodity egg producer, ignoring its 70% plus dominant market share in the pasture-raised niche. Probabilistic thinking, upside potential versus downside defense. Looking at the 2026 juncture, I apply probabilistic estimates to where this egg might land. Base case, 50% probability. VITL maintains 15% to 20% CAGR, reaching $1.5 billion in revenue by 2029, with an EBITDA of roughly $220 million. At a conservative 10 times EV/EBITDA valuation, the target market cap should be around $2.2 billion, offering 3 times to 4 times upside from current levels. Bull case, 30% probability. If new capacity translates into margin recovery as planned, and the brand successfully pivots into high-margin categories like butter and liquid eggs, exceeding 15% of revenue, the market will return to a high-growth brand valuation, 15 times EBITDA. The stock could then challenge $80 to $100. Bear case, 20% probability. Assuming frequent avian flu outbreaks or a prolonged price war that locks gross margins below 35% and drops annual growth to single digits. Even then, the balance sheet, with zero long-term debt and approximately $110 million in cash, provides a formidable defense. The stock would likely find strong support near $10, backed by net assets and residual brand value, limiting downside to roughly 20%. In summary, Vital Farms' current distress is a classic case of scaling pains. The current share price plunge looks more like a thorough debubbling process. As long as core financial data, specifically household penetration, continues to grow and unit processing costs decline as scheduled in 2027, this falling egg will not break.